Welcome to the Opening Bell Report.
Today, we're digging into an analysis of Datavault AI, or DVLT.
And it's a big one.
A very big one. The report is forecasting a revenue jump from about $2.7 million to over $30 million in 1 year.
That's 1,000% increase. I mean, that's the kind of forecast that gets everyone's attention.
It does, but it also invites a ton of scrutiny. And when you make a claim that big, the argument has to be completely airtight.
Right. And right now, I think this analysis has a few spots that need reinforcing. It's a bold report, so let's get right into it.
Okay. So the first thing that really jumps out is how the report handles the company's big operational pivot. It identifies it clearly, the shift from their old acoustic science business to this new RWA tokenization model.
Yeah, the drivers, real-world assets, Web 3.0. It mentions the $49 million tokenization deal.
And the API media acquisition.
Right, but the weakness is that it treats those announcements as if they're the same thing as realized revenue. It just implies that you flip a switch and suddenly the old tech is making millions in a new field.
It just skips a step, or like 3 steps. It jumps from legacy tech straight to profit without showing any of the machinery in between.
Exactly. It's relying on the buzzwords, so my suggestion would be to really draw a clear, explicit line connecting the old technology to the new application.
Show the plumbing.
Show the plumbing. Prove that the $30 million isn't just a number they pulled from a press release. The reader needs to see the operational logic.
Okay, so a concrete example could be contrasting the old sort of niche acoustic work with what they're doing now.
Like with the Sports Illustrated Digital Asset Exchange?
Exactly. How are acoustic data frequencies being used to, say, verify those digital assets? If you explain that, then it's not a pivot anymore. It's an evolution. It makes sense.
And you could even add more detail on the money itself. I mean, I'd love to see the connective tissue between that API media acquisition from January and the FY25 bottom line.
Right. The report says it adds immediate revenue streams, but how much?
Is it 2 million? 10 million? Who knows?
So a simple way to strengthen this would be a section that breaks down how the $49 million agreement turns into a $30 million target for this fiscal year.
Is it licensing, transaction fees?
Service fees, anything. Just show the math.
Yeah. If you can show that, the 1,000% growth starts to look less like a slogan and more like an actual financial model. Right now, it's a bit like step 1, acoustics. Step 3, profit.
And step 2 is just a giant question mark.
A giant question mark.
Okay, so moving on. Let's talk about risk. The section on market skepticism. It does a good job identifying the price disconnect. The stock's trading at around 79 cents versus its projected value.
But it kind of overlooks how severe the dilution problem really is for investors.
This is where the report really pulls its punches. It lists the facts. Share count exploded from 4 million to over 52 million.
A $51 million net loss.
It lists them as bullet points. But the weakness is that it treats a 13x explosion in the share count as just a normal microcap feature, something to just acknowledge and then move on from.
Which is really underselling the damage. A 13x share count expansion isn't just a feature. It's a massive red flag. For institutional money that can outweigh any revenue story.
Mathematical violence is the term that comes to mind.
It is, and so the suggestion is to reframe that whole skeptics view section. It needs to be less about math and more about trust.
Ah, okay.
The report needs to argue that the low stock price isn't just skepticism. It's a vote of no confidence in management's ability to stop printing shares.
That's a much stronger angle. So, for example, instead of just saying the price is 79 cents,
you connect it directly to that awful Q3 earnings miss. They reported negative 33 cents a share when the estimate was negative 7 cents.
That's where the trust evaporated.
Exactly. And another thing, the report uses that peer trading multiple argument, that similar companies trade at 10 to 20 times sales.
Right, to justify a higher target for DVLT.
I think you have to argue that those multiples are totally irrelevant until this company proves it can stop bleeding $51 million a year.
The comparison doesn't work if the fundamentals are completely different.
Right. And an actionable way to do that is to ask the question, is $30 million in revenue even enough to stop the dilution?
That's the key question, isn't it? Because if the burn rate is $51 million, and revenue is $30 million,
you're still $21 million in the hole.
Which means you're going to have to print more shares next year.
Exactly. And if the report addresses that head on, it becomes so much more credible. It's not just listing risks, it's explaining why the market is pricing the stock at 79 cents.
It turns it from a promotional piece into a serious analysis. Okay, now let's look further out. the future projections. The report just sort of accepts the FY 2026 forecast of $200 million.
Yeah, this part was jarring for me. There's all this analysis on how they get to $30 million, and then for the jump to $200 million, a nearly 600% increase from there, the report just kind of nods along.
It feels like a foregone conclusion.
It does. The weakness is that there's no real analysis of that second jump. It's just presented as the next logical step. Right, it mentions becoming a mid-cap contender, but provides zero evidence for how the infrastructure could possibly scale to support $200 million in business just a year later.
You have to wonder, can the team that ran a $2.7 million acoustic company a year ago suddenly run a $200 million tokenization empire? That takes hundreds of new people, servers, compliance.
None of that is mentioned. So the suggestion here is to treat that FY26 number as its own separate high-risk hypothesis. Don't lump it in with the FY25 data. It needs its own stress test.
A great way to do that would be to connect it to the other events mentioned. Like, the report says there's this Mar-a-Lago event on February 11th for serious capital backing.
Okay, so you ask the question, is that capital specifically for building the infrastructure needed to hit $200 million?
Or what does failure look like? Model it out. What if they only hit $50 million in 2026? It's still huge growth, but does the whole thesis collapse? Does the stock crash?
You have to temper the exponential growth rocket language with a scalability stress test section.
Now, reality check.
A reality check. Right now, that $200 million just feels like a number on a spreadsheet, not a business plan.
It really does. Which brings us to the last point. And this is where it gets really interesting for me. The timeline.
Yes.
The analysis mentions these critical dates, the Super Bowl, the warrant distribution, but it completely misses the chance to weave them into a narrative of what you could call corporate engineering.
This is the most exciting part of the whole story, and the report just glosses over it. We've got Super Bowl activations,
The Mar-a-Lago investor event on February 11th.
and then the warrant distribution on February 23rd. The weakness is that the report treats them like they're in different silos. You know, this is marketing, this is finance.
But they're not separate. They're all happening within about 2 weeks of each other. That has to be a coordinated push.
It has to be. So my suggestion is to weave these timelines together to show the intent.
Right.
The CEO isn't just hosting a party at Mar-a-Lago for fun, he's doing it just days before the warrants are distributed.
So the analysis should just state that outright. The 1,000% growth story is almost certainly timed to support these very specific February financial events.
It's not a coincidence. A perfect example would be to analyze the risk sequence. Ask what happens if the Super Bowl activations fall flat. If they don't generate buzz, does the warrant distribution on February 23rd become a total non-event?
Because if the stock isn't over the $5 strike price by then, the warrants are worthless.
Exactly. The report needs to say that. This is a high-stakes strategy to get the stock over $5. That changes everything for the reader.
It validates the skepticism we were talking about earlier.
Right. When the reader understands that the 1,000% growth forecast is the fuel for the warrant distribution engine, the whole report feels more sophisticated.
And less like a press release, it shows the analyst understands the why behind the what. It adds a timer to the whole thesis. They need this to work in February.
Yes.
So, to wrap this all up, the report has a really strong core. The 1,000% growth headline is potent. The math from the company guidance is there.
It's undeniable, but it needs to bridge that gap.
It does. It has to connect the dots from acoustic science to the reality of RWA operations. You can't just throw out buzzwords.
And it has to get real about the dilution. Going from 4 million to 52 million shares it's a traumatic event for a stock. You have to explain why the market is so skeptical before you try to convince him otherwise.
Absolutely. Then, treat that FY26 $200 million number with the skepticism it deserves. Frame it as a high-risk, high-reward scenario, not a guarantee.
And finally, connect that timeline. Show that February isn't just a busy month, it's a calculated financial maneuver around those warrants.
I think the most actionable thing for the writer is to go back to that skeptic's view section.
I agree.
Stop being defensive, analyze the burn rate, analyze the dilution. Give the reader the full picture of the risk, because that will actually make your argument for the reward much, much stronger.
It's so close to being a fantastic piece of analysis. It just needs to stop being polite about the ugly numbers.
Well said. I'd love to see a next draft that really builds out that connective tissue we talked about.
Me too. If they can nail that and the corporate engineering timeline, this could be the definitive analysis on the company.
We invite you to refine the report, focusing on those operational links, and submit the next draft for review. Thanks for listening.
Don't forget to like, share, and subscribe for more.